Rising oil prices, potentially higher U.S. Bond yields and a stronger dollar. Those are some of the things that have been playing out on the global economy and the global markets. What does all of that mean for the Indian economy? Joining us to help us understand some of those changing dynamics is Jahangir Aziz of JPMorgan. He joins us from New York. Jahangir, thanks so much for taking the time to speak to us. My first question is just that, changing dynamics on the global front. In fact, I think just saw that the Fed's inflation indicator has hit 2%, which is their target. Yields have been on the rise. The dollar has suggested some strengthening. Right. How should India sort of expect to deal with all of this?
I think there's a repricing that is taking place where the market had been behind the curve in terms of, what the Fed was signaling for a very long time. I think the market is now getting to a point where it's starting to believe what the Fed is talking about. 3 rate hikes in 2018 and 2 more in 2019. We in JPMorgan have a higher set of rate hikes both for 2018 and 19. But I think the reaction that you're seeing in the market, both in the 10-year as well as in the US dollar strength, is simply that the market is basically moving up closer to the dots and what it implies for the dollar, rather than this being driven by something that's happening fundamentally to the global economy, to the EM/DM growth dynamics, or in terms of surprises on the inflation front.
You are expecting at JPMorgan, Jahangir, say yields upwards of the 3% mark, or a dollar which is much stronger than it has been over the past year?
No, so we are expecting the U.S. Treasury to end somewhere close to 325 for 2018. However, we think that with 325, given the growth dynamics, particularly between U.S. and Euro area, and given what are the drivers of U.S. growth at this point in time, which is almost like 1.5–2 percentage points of higher fiscal deficit, accompanied by 1.2 percentage points of higher current account deficit, even with the increase in the U.S. Treasury rates closer to 3.25, we would continue to see a benign or a weakening dollar against the euro.
So in that scenario, does an economy like India take a potentially lesser hit than a scenario where we had higher yields and a stronger dollar? Because I think that combination has been what has been worrying domestic markets a bit.
Right. So I think there are two separate issues over here. There is the global emerging market, developed market trends, and then there is the India-specific factors. So if you look at the global emerging market DM trend, the biggest driver of flows into emerging market has always been the growth gap between emerging markets and developed markets, and that we expect to see widening in favor of emerging markets throughout 2018 and 19. Interest rate differential actually matter much less. What really matters is dollar strength or dollar weakness. So in an environment in which we see EM/DM growth differentials favoring emerging markets, as well as the dollar remaining benign or remaining pretty soft against the euro, we do expect for emerging market flows to remain strong. There will be episodes, as we have seen over the last 2 weeks, where there's increased volatility because the market is repricing to it. But once it goes back to the fundamental drivers, we do expect emerging market flows to continue. But then there is the India factors. So as far as the India macroeconomics is concerned, there are again, two basic drivers of Indian macroeconomics right now. Fundamentally, the fiscal deficit is widening, and along with that, the current account deficit is widening. And the current account deficit is widening not just because oil prices are higher, that is adding to it, but fundamentally because savings in India is falling short of investment, largely because the government is actually saving much more. In such an environment, you do expect rates to be higher and the currency to be weaker. And that's essentially what India is facing. Now, you can try, as the government has done and as the RBI has done, put band-aids to it, by extending forbearance, by playing around with the issuance, easing a bit on the side, as they did last Friday, the restrictions on foreign investment flows. But fundamentally, India will be facing these pressures because the macroeconomics has changed in 2018-19 as opposed to what we have seen in 2016 and 17.
On that point, on what the RBI did on Friday, Jahangir, what did you make of that? I mean, it was the short end of the curve that got us in the 2013-14 period when the taper tantrum started. Not to say that our economics are back at what we were in 2013, but it seemed like a slightly reactive policy. Or do you think there is some merit in easing up these restrictions on FPI flows on the debt market?
Again, there are two separate issues over here. The first issue is that whether or not India, as a strategic decision, should it allow more foreign investments into government securities, i.e., should it add to the demand or add new demand to government bonds? And if you look at most emerging market countries, have increased the amount of foreign investment flows into their local bond markets. Including in China, which was sort of the India-like behavior, which is that they would open up everything except for the bond market. But if you look at what China is doing over the last 6 to 9 months, it has opened up the bond market significantly. And almost all other large emerging market countries have no restrictions of foreigners into the bond market. And the sky hasn't fallen down on the heads of these emerging market economies. So that's the strategic view. And I think along with that lines, there should be increased openings of foreign investments into the bond market. Apart from increasing the demand or adding to the demand for Indian bonds, it also adds, and this is the crucial factor, it also adds a little bit more market discipline on the Indian government in terms of what they can do in fiscal policy and not. Because as far as the Indian markets is concerned, taking an action against, given the capital controls, is very difficult to actually stay away from Indian bonds, even if the fiscal deficit is going to widen. So that's the first part of it. The second part of it is what you want to do in the short term. In the short term, I think, Reserve Bank of India and the government of India has always had this problem of actually conflating two things, which is short-term instruments with short-term investors. If you look at the depth of the 10-year market, then I can always be a very, very short-term investor, even in a 10-year instrument. So restricting the duration of the instrument didn't really ever make any sense, because there are large number of very long-term repeated investors in India who like to prefer to be in the short end of the bond, so short end of the tenor. So I'm glad that the RBI has lifted that restriction, because it doesn't really make much of a sense. To your more bigger question, does this imply greater volatility? All depends on the macroeconomics and how RBI and the government plays with the macroeconomics. If they maintain macroeconomic stability, like any other emerging market country, it will continue to attract foreign investments into the bond market. If it doesn't, then people will leave. So it's much more to do with macroeconomic stability and macroeconomic policy than whether or not you're allowing people in the short end or in the long end.
Are there risks on the horizon for macroeconomic stability, Jahangir, to your view?
Well, look, as I said, for India, there are fundamental changes on the macroeconomics are two things. One is that we are facing a much higher current account fiscal deficit this year than in the past. In the past, if you look at state and government fiscal deficit, they had broadly been kept around 7%, 6.5–7% of GDP. This is a year in which you are likely to see the 7% of GDP being breached, and how much it gets breached, it's anyone's question, but it could be very much closer to 8% than 7% this year, given what's happening to the state and given what's happened to the central government's own fiscal budgetary plans. And let's add to it the fact that this is also an election year. The other side of it is that, in 2016 and 17, the current account was kept very, very low. And I think that was the biggest, support to macroeconomic stability. This time around, current account deficit is going to widen with and without the oil prices. With high oil prices, it's going to be even worse. We are looking at somewhere close to 2.5–3% of GDP, which is a far cry from what it used to be, last year or the year before that, where it was closer to 1–1.5% of GDP. So if you're facing fundamental shifts in the macroeconomic stability. You are going to continue to face pressures both on the interest rate front as well as downward pressures on the rupee. So I think this is what is different in 2018-19 as opposed to what it used to be the case in 2016-17.
And on inflation, Jahangir, Michael Patra is of the belief that we are behind the curve just looking at the way bond markets have moved. I think Veeral Acharya is moving in that direction as well, voting for a rate hike. Do you see risks on inflation?
Look, there are two parts to the inflation story. One is, of course, what happens to food. And there you have been, India has benefited from better food management, and food inflation has actually surprised on the downside. But then you have the MSP increases coming up, and it is unclear how much the MSP increase will be. Clearly, if there is a reasonably large MSP increase, 50% of cost, depending upon what formula they follow, there could be an increase in food inflation going forward. Core inflation, on the other hand, which is probably what members of the MPC pay more attention to, that has been stubbornly high around that 4.5–5% range for a very long period of time. And this is not the first time that members of the MPC has warned about India being behind the curve. This is probably the second review in which members of the MPC have made that argument. This time around, there have been many more MPC members who are making the argument. The problem, I think, with the Reserve Bank of India is not that that the inflation is moving up, etc. I think the Reserve Bank of India right now is back to this problem of trying to balance its multiple objectives. So if you go back to what the Reserve Bank of India actually does, there is inflation targeting. It is also the the debt manager of the government, as well as a keeper of financial stability. And these three objectives, normal times are fine, they don't come into conflict, but there are certain times when these three objectives come into conflict. And this is something that has been warned by the previous governor, Governor Subbarao. He talked about the trilemma facing Reserve Bank of India. By the Sri Krishna committee report was very, very detailed and explicit about these three different objectives come into conflict, and there needs to be a separation of these three objectives. That hasn't happened. Right now, it is very difficult to figure out what is it that the RBI is targeting. Is it targeting the inflation rate? Is it targeting the 10-year rate? Or is it targeting financial stability by making sure that, at least the public sector banks' capital remains more or less preserved because of the extension of forbearance that is doing at the same time? This is when those three multiple objectives have come into conflict. And again, I'm looking at the monetary policy review, looking at the minutes, looking at the action, the 10-year rate, or as a debt manager, what the Reserve Bank is doing, looking at what they're doing on the regulatory front. And it's very difficult to figure out what is it at this point in time that monetary policy is targeting.
Great point, Jahangir. I have time for one last question, and I want to slip in one on the banking issues. I think you've spoken number of times. We've spoken in the past. You've said we have to fix this banking issue. The banking issue is still not fixed. Someone the other day said to me that policymakers seem fairly clueless on how to even start fixing the issues. What is your thought on the whole banking problem and the interplay with the economy?
Look, again, we have sort of spoken about this a number of times. This is not a new issue. We were flagging it back in 2013-14 that there would be a time when this would become the binding constraint to India's growth. It has been the case for the last 2 years. I think the government or the RBI both together are trying to solve too many problems at the same time. There is a moral hazard issue. Should we go and recapitalize public sector banks once again, because this is only going to encourage them to take bad actions later on. So let me try and make sure that a risk management system is put into place along with the capital that is injecting, etc., etc., etc. And there is no real clarity, or I would say there's not real clarity. There is clarity. They want to fix all the problems of the banking sector at the same time. However, there is no urgency. That is the issue that I have with the government's and the RBI's program, that they seem to think that they have time in their hands. They seem to think that letting all of the processes that they have put into place, and not just this particular leadership in the RBI, even the previous leadership, all of that is going to take a very long time to actually get fixed. In the meanwhile, the public sector banks and the banking sector problems continue to fester, and I think that this idea that they have time, I think that most likely will be increasingly challenged as we go into 2018 and 19.
All right, Jahangir, thanks so much. Appreciate you taking the time to give us views on some new issues and some very old issues, as you pointed out. Jahangir Aziz of JPMorgan there.